We've got Steve Allan with us today. So great to have you here to actually talk about valuations and in particular 409A. We get a lot of questions asked about what is a 409A, why are they called 409As, what are they used for, and typically when does a startup founder actually have to start thinking about these?
So 409A, it's just our IRC 409A, which is just an IRS ruling. And ultimately, it just said that when you issue stock to employees, or to anybody, in fact, you have to issue it at fair market value or what it's worth too. If we date back to the early 2000s, where the Enron days, or probably more famously Steve Jobs, where they were issued stock options that were deemed as in the money. And so they were given stock, but then not taxed appropriately on it. And so this ruling came through in 2006 and really helped kind of set a baseline and said, okay, we need to make sure we know what the value of the stock is that you're issuing to your employees so you can set the correct strike price for them. Why you need it is because within this IRC 409A ruling, the IRS essentially said you can do it yourself or you can go hire someone to do it. If you hire someone who's an independent qualified third party, then you get this thing called a safe harbor. And safe harbor basically means that the onus now falls on the IRS to prove that the value of the stock is wrong. Whereas if you do it yourself, then the onus actually falls on you to prove that it's right. So ultimately it started this boutique business specifically around, okay, how do we value these stock options so that companies can issue them to attract and retain their employees? When you're looking at a 409A, you're really just looking at how you value the common stock that you're going to be issuing to the employee itself. And it's very explicit, by the way, in the 409A guidelines from 2014. It is not about an enterprise value. So they really wanted to make sure these two were completely separated and understood the difference between the methodologies of it. Also, one of the things to think about is often what happens when you're fundraising is you're selling preferred shares, and preferred shares have rights and preferences that make those shares inherently more valuable. Yeah. And so the 409A you'll often see is at a discount, and often a significant discount, to the most recent preferred share price. And so you can often see those ratios be anywhere from, 1 to 5 to 1 to 2, and depending on the stage and development of the company and what those rights and preferences are. Yeah. But ultimately, it does help serve the benefit of what you want 409A for. You want it to value the strike price of the options. Ideally, you want that as low as is reasonably defensible. Yes. Because again, it's an HR tool specifically to help your employees that take into account the valuation of what's happened at your fundraising event, but ultimately also understand that the specific rationale behind this is to help those employees participate in the upside. And we already know that being an entrepreneur is the hardest job out there. And so this should also be relatively quick. So you should be able to get a valuation right at the early stages. Typically on an early stage, you're gonna see kind of a, what I'll call 20 to 25% common preferred ratio. So if it's $10 for the preferred price, you're gonna see kind of $2.50, maybe $3 for the common share price. Yeah. If you do see it that's getting significantly lower than that, let's say it's down to a 10% common preferred ratio, that tends to be a red flag, either for your auditor or for the IRS in the future. And so if you think about how valuation is done, they have some guidelines and governors. If you pull a lever too far, it actually pushes another one automatically the other way, so it keeps it within that range. If you see the opposite, which is your early stage and you're getting kind of a 50% common preferred, unless it's a unique capital stack that you have put in place, it's probably a bit conservative. It means that your evaluator is saying, hey, I never want to deal with a question from the IRS, the auditors, anybody. But that's really unfair to your employees because it's left that additional, call it 25%, that they could have appreciated in value as the company grew. So again, we always have to keep in mind that this is a attraction and retention tool. It's for compensation purposes. So we really need to make sure, as we've said, that it's defensible, but it's kind of on the lowest end of defensible because that ultimately accomplishes everybody's goals. You should be watching your price, right? These things really shouldn't be astronomically expensive. I think anything from $1,000 to $3,000 is going to typically be where the pricing range would be. Yeah. That being said, you do want to make sure that you qualify for the safe harbor. It's the whole reason you went and did this. Yeah. Which means that you have to use a qualified firm And so those firms can get that either through certifications or by the number of valuations they've done. Last, I'd say if you have questions, you should have a valuation writer that's willing to hop on the phone and walk you through that, or hop on a Zoom or video link or video chat to be able to do that. Because again, it's your valuation. They're the service provider. You really need to understand what it is you're signing up for. Yes, it may sound like a boring compliance thing, but that boring compliance thing is something that actually helps to unlock that opportunity. And so that's really why we got into it and said, how do we just help, continue to feed the flywheel of innovation and see what else can happen.